IT companies. In fact, talking about mid-cap IT, we do have Happiest Minds on our radar. We have Joseph Anantharaju, the Executive VC and CEO, Product Engineering Services, and Venkatraman Narayanan, who is the MD and CFO of Happiest Minds, joining in to discuss the Q1 FY23 performance. Mr. Anantharaju as well as Mr. Narayan, thanks very much for joining in and welcome to the show. Mr. Narayan, I'm going to start with you. The broader question is on margins. Where exactly do you see margins here on, given that, salary hikes are pending at this point and the economy is back in terms of function, travel costs are rising?
As you may have seen from our results, we have hit a high of 26.4% on our EBITDA this quarter. And this is in line with almost all the largest industry peers and the highest amongst mid-caps, I would say. So while that be so, I've been guiding that on a long-term or a medium-term sustainable basis, our margins would be in the range of about 22% to 24%. So like you rightly said, there are certain costs which are likely to come back because we have now started working from home, and some of the credits that we used to get during the COVID season in the last 2 years is beginning to reverse. So you've got wage hikes which are likely to happen starting next quarter. We will be increasing wages for a large part of the Happiest Minds family next quarter. That will have an impact, while some part of that would be made up through the value and volume growth, and maybe also the way the rupee is moving. It could give us benefits, but I would like to be on the safer side, guide for 22 to 24% of margins on a sustainable basis. Most importantly, wouldn't want to stay away from making any investments into new technologies or new verticals that we need to focus on. And because that would be a travesty if we didn't do the right investments, looking at maintaining high margins. And so the margins will surely be, I wouldn't want to use the word sacrifice, but we would like to maintain it at a lower number to get those revenue growth.
Sure, got that. So you're sticking to your margin guidance band of 22 to 24%, and you said that you wouldn't want to hesitate to make new investments in technology. Can you tell us exactly what are the investments lined up? What do you see as the potential, and how much are you looking to spend, say, over the next 1 year?
So in terms of areas, Sonia, we continue to sustain some of the investments and technologies that we've been making in terms of blockchain or cloud infrastructure security. But a couple of new areas that we've decided to focus on this year are well-known names, Metaverse and Web 3.0. We already have a small team working on these. We are looking at building out demos and use cases that we can take to our customers. And in fact, we have a couple of customers already where we're on the verge of doing implementations based on some of the POCs that we've created. So these two areas will see a fair bit of new investment in addition to what we're already investing. And the other area that we are looking at investing is in the building domain expertise and consulting capability. We've brought on board quite a few domain heads who are building their teams so that we can talk to the customers more in their business language and help them translate some of their business ideas and objectives into more of IT roadmap and IT initiatives. So those are two broad areas where we'll be making investments for the current year.
Right. Just wanted to understand a couple of things, Joseph. The first one, of course, is the net employee change quarter on quarter has just been 20, and this on an average has been over 200. So is there a one-off out there? What explains this muted hiring? And secondly, 2 quarters in a row, high-tech has been rather soft. So when does that improve?
Sure. So on the first one, it was a little in a way planned actually, Mangalam. We have our campus batch joining us next month. We have around 300 people, give or take, depending on how many finally join. And so we went slow on the fresher hiring in Q1. Typically, that number would have been a net of 80 people. So we eased up on that to ensure that the batch that we bring on board this quarter, we should be able to start deploying them once they finish their induction. The other reason was we maintain a little bit of flexibility. Our plan is to look at partners a little bit more than we would so that we have a little bit of flexibility in our operations. So that those were the reasons. But we continue to aggressively hire our, as you would see, our gross addition was 200 plus, and so the recruitment efforts are still continuing on an aggressive basis. And in terms of high tech, what's happened is two factors actually, where you've seen a little bit of numbers remaining constant across a couple of quarters. One is one of our larger customers where we were doing a PIMCore implementation. It was more on a fixed price project basis that came to an sort of came to an end between Q4 and Q1. And the second reason is one of our larger customers, which is a late stage venture funded company. The minute they saw some of the macroeconomic geopolitical situation, they're very, I've seen them being a little bit more careful in the way they manage their budget. They did ease back on their spend. But what we're seeing is the same customer who's been with us for 7 or 8 years now, they're seeing their demands sustaining from their customers, more requests for functionalities, and we're seeing them come back and starting to ramp up. So we should see a reversal of that and an increase in the high-tech vertical in Q3.
Okay, all right. So you're expecting the high-tech contribution to probably rise Q3 onwards. Mr. Narayanan, you know, a larger question with regards to demand and what you're forecasting in terms of trends in FY23. Gartner came out where they, came out with their report where they've reduced ID spending to around 3% growth versus 4% earlier. But you're expecting 25% CAGR in the next 5 years. You've raised your FY23 revenue guidance as well. Give us a sense in terms of the demand drivers and what you're anticipating in terms of demand this year.
Well, I'll give you a headline number on how we came to this 25% number. I would like Joseph to add on what he's seeing in the market. If you realize, we had in the past quarters talked about 20% growth consistently on an organic basis. That's the number that we had put out. Now that the first quarter is behind us, we revisited those numbers because we have started the quarter on a very good footing, firm footing. Seeing the way revenues have stacked up just made it possible, and it gave us the confidence to move that number to 25% over the rest of the year. So that's for the next 3 quarters, it's going to be 25% growth again. If you look at the future, we have not differentiated between inorganic and organic growth. And so there would be an element of inorganic growth coming in to come to that 25% number. And it's only right to do that because we have set for ourselves $1 billion target at the end of 2031. And if you are to do that, you have to grow at about 25% CAGR. And that's one of the reasons why we have also gone ahead and corrected or set our aspirational targets at 25% for the 5 years succeeding FY23.
Okay, all the best.
Respect to,
yes, go ahead.
Yeah, and with respect to demand, Sonia, Ram, Rajiv, and myself, the last 3 months we've been going and meeting customers, especially after the geopolitical situation, right? Just to get a sense of which direction customers are going. And by and large, what we've seen is that the demand and environment has sustained, especially for digital initiatives. What has already been started, customers are finding ways to fund that even if they need to optimize on some of their costs. And so barring a situation here or there like the high-tech company that I mentioned, we've really not seen a flag off in demand, and we're hoping that will sustain.
Okay, all the best. It's been a very strong quarter for you, and the stock is also reflecting that, up almost 3.5%. All the best, gentlemen, and thanks for joining us on CNBC TV18. Well, that's the word coming in from Happiest Mind. In fact, a lot of the mid-cap IT numbers have been pretty strong this time around, many of them raising their guidance as well. So the going has been good. Let's slip into a short break. The markets are doing well. On the other side, we'll get you an exclusive conversation with Sanjeev Mehta, the MD and CEO of HUL. Do stay tuned in.